Hi, this is Michael Yardney, and I've been investing in property for a long time, since 1970, and I don't really remember investor market sentiment ever being so low. 2008's been different to other downturns I've experienced. The financial lashings we're receiving just seem to go on and on. Every day there's a different bogeyman out there. You're never sure what you're going to hear in the news or read in the press. In fact, I know a few people who've given up reading the papers, not because they're burying their heads in the sand and pretending nothing's going on, but because they're disappointed by the negative bias in the media. Having said that, I don't believe what we're going through is anywhere near as bad for Australian business, or in fact for our property markets, as we experienced in the 1990-91 recession. And everyone I've been speaking to about this, who was investing in those days or who is in business in those days, agrees. So recently a few clients have asked me, well, Michael, if you're suggesting we buy another investment property now, does that mean that the market's bottomed? And my honest answer is, I've got no idea. But the answer is, probably not. And then I ask them, but are we really buying the market? Clearly the answer is no. You're investing in a property or a small number of wisely chosen properties. This means that for astute investors, there are some incredible opportunities around at the moment. But you can't just buy any property. At this stage, you really have to do your research very thoroughly. What we've found is that in this market there are some really motivated and at times desperate vendors, and this creates some top buying opportunities for long-term investors. For example, I've heard of one very keen vendor who sold his 3 apartments in the same block of units in a top inner Bayside Melbourne suburb recently. I know all the apartments were renovated and they were tenanted, and they were probably worth much the same. But this investor needed to liquidate his investments urgently. Look, I don't really know what was going on. Maybe he had a major loss in the share market or whatever, but he put all 3 apartments up for auction on the same day. Now, there were buyers in the crowd at the auction, but clearly not as many as would have been around earlier this year or last year. Last year, these properties would have easily sold for $450,000 each, but this year, the first property sold at auction for $425,000, and there are a few keen bidders pushing up the price. The second apartment, which was very, very similar in the same block, was passed in at auction and sold shortly afterwards for $405,000. Now, the last apartment was also passed in. There were no buyers and no one bid for this property. It was sold a few weeks later to a canny investor for $385,000. Now, what lessons can we take from this? Now, as these apartments would have easily sold for well over $450,000 last year, that probably means that all the new purchases will do very well in the medium to long term. In fact, I understand that the investor did really well because he bought those properties for around $200,000 each. But if you look at it, the purchaser of property number 3, the third purchaser, he purchased exceptionally well, didn't he? Now, knowing that particular location well, as Pam and I own a number of properties in the immediate vicinity, I believe that in today's market, the properties, if marketed correctly, would have all easily sold for at least $425,000. But there just weren't 3 buyers there on that day, and apparently the vendor was very motivated. So buyers number 2 and 3 bought well. Even if the market falls another 10% or so, buyer number 3 is still ahead, isn't he? Now that's the sort of property you've got to buy today. One that you'd be happy to hold on to in your portfolio for the long term, and then one that was bought sufficiently below market price so that even if the market fell a bit further, you'd still have bought well. You see, the rules are very different today, different to what they were a few years ago. You can't just go out and buy any property and hope it'll increase in value. You've got to buy in the right location. That's interesting, isn't it? That old rule of location, location, location that was forgotten by many investors over the last few years now comes back into play. And those who forgot that rule, they're now suffering. Those who need to sell, and they've got their properties in secondary locations, just can't sell. You see, there's currently many secondary properties on the market, properties on main roads or poor locations, and these are properties that are just not selling, and even though some of them are owned by desperate vendors who've dropped their asking price, don't be tempted. Stay clear of this type of property. Instead, look for top properties, bought in the top locations, considerably below market value, and in particular, consider those properties to which you can add value so that you can manufacture some capital growth yourself through renovations or property development. With the end of the year fast approaching, I suspect there's going to be some outstanding buys available over the next month or so. Any vendor who's put his property on the market and hasn't sold it is going to get more and more nervous as we get closer to Christmas. I found that as we get near to the end of the year, many sellers almost give away their properties to get a sale over the line before the Christmas break. So has the market bottomed? Probably not. But having said that, my views of the property market could be summed up simply as follows. Number one, I've got really strong positive views on the property market in our capital cities in the medium to long term. And over the last couple of months I've been explaining this in my newsletter and the regular updates. But number two, I'm certainly aware of potential short-term problems related to the credit crisis and poor market sentiment, which means, number three, you should be buying the right property and the right price at the right location with the right rental income and one to which you can add value. So are you ready to exploit the opportunities our current property markets are presenting and those that are going to arise shortly? We're going to keep you up to date with articles from Australia's leading experts on our Property Update website, and you can always get the latest news from the media from Australia and in fact from around the world on the property news page of this website. So come back regularly to get the latest updates. I'll also keep you updated every fortnight with my regular video commentaries. Now the team at Metropole are conducting regular property briefings, and we've got a couple more to go before the end of the year in our boardrooms in Melbourne, Sydney and Brisbane, and in our associated office in Perth. We're conducting these briefings to help investors understand their local property markets and the opportunities that are going to arise. So please join us at one of these. To reserve your place in the next week or two before the end of the year or for early next year, just click on the link below, find out more details and come along to one of these briefings. I look forward to presenting another update for you in my next issue. Thanks, this is Michael Yardney.